My name is Michael Guyad, publisher of the Lead Lag Report. Joining us for the hour, Grant Williams, who has a phenomenal podcast himself. Grant, I got to tell you, the first time I came across you was in listening to the interview that you did with my buddy George Noble, which I'll see if I can get him in to come as well, talking about Bitcoin, which was very well timed back several months ago here. But for those who aren't familiar with your background, just talk about who you are, how'd you get involved in markets, and what are you doing now?
Yeah, I mean, I won't take too long over this. It's a decidedly unremarkable journey. I joined the industry in 1985, fresh out of school. Spent my formative years involved in Japanese markets through the end of the kind of Nikkei and Japanese real estate bubbles. I was out in Tokyo working for a now defunct company called Jardine Fleming when the bubble burst at the end of 1989. And, over my career, I've traded equities and derivatives and convertible bonds and JGBs when they used to have a yield. I was a portfolio manager for a hedge fund in Singapore for a while. And then in 2014, I set out to co-found a company called Real Vision with some friends, which was a fascinating experience for me. I left there at really the end of 2018 or first quarter of 2019 and went back to doing what I've done now for 15 years, which is write a letter called Things That Make You Go, And the podcast that you mentioned really was born out of the pandemic. I was sitting at home and was having conversations with a bunch of really smart friends of mine all around the world to try and understand what the hell was going on, and just figured, these are conversations that people might want to listen to. So, I started broadcasting them and letting people get the insights, just like you're doing with these spaces. So, I think it's important to try and give people as much room to hear opinions as they can right now, because, even experts in whatever field you look at are confused because these are confusing time. The waters are churning left and right, and it's very difficult to formulate an opinion if you can't challenge it with the smart thinking of other people. So I think that's a crucial thing to do right now.
And personally, I'm a fan of Real Vision. I am on fairly regularly, and I'm glad that there are people like you that focus on long form conversations, because it's very hard, to your point, to really understand what's happening or even to think about what's happening through just sound bites, right? And it's always amazing to me to see the kind of engagement with these long conversations when traditional media would argue you want to go for those kind of quick hits, those momentary fleeting things that people want to gravitate towards, and instead of getting into the more kind of thoughtful conversation. Now, I want to focus on the word opinions for a moment here, because the reality is everything that we hear when it comes to anything related to the future is an opinion, right? It's always based on some thought about what could happen, because nobody can predict what tomorrow brings. And you and I both know the old saying, right? Opinions are like noses, or maybe a more colorful part of the body. Everyone has one, right? Talk about, in your experience in talking to different guests, different thought leaders, what are the opinions that tend to grab your attention? Because it can't just be a function of clickbait, extreme thoughts on what's going to come tomorrow. What makes you interested in what somebody has to say?
Yeah, it's a really interesting question, and it's interesting that you choose that term, grabs your attention, because that is really what it's all become about. Everything is about grabbing people's attention. The world has an ever decreasing attention span over the last number of years, and there are an increasing number of distractions to people, which kind of take their focus away from, as you mentioned, that long form content. And for me, I believe firmly that the long form content is ultimately where all the information lies. Because if you get the soundbite, snappy kind of stuff, you're missing out on the substance. You're getting the style, but you're not getting the substance. And I think sitting down and talking to someone or listening to someone for an hour or longer gives you a much better sense of who they are, gives you a much better sense of how they form their opinions, which is in many ways as important as the opinions they form. And it gives you a chance to process that information. And I think people have become conditioned to believing everything that man on TV tells them without really questioning it, and B, people have gotten lazy in terms of doing their own thinking. And I think you can only get so far by listening to conversations with other people. If you listen to a conversation, you take everything at face value and you invest or trade accordingly, you've failed on the most important part, which is to take that information, sit down and process it yourself, challenge it, stress test it. Do you agree with it? Do you not agree with it? And oftentimes you'll come up with reasons to disagree with that opinion. It doesn't mean that person's wrong and you're right. As you said at the beginning, it's very important to understand that we're all guessing about an unknowable future. So again, going back to that long form content, you get a much better idea of the level of rigorousness that someone puts their ideas through when you get a chance to talk about how they stress test them. So I think it's a tug of war at the moment between a culture and a media that is desperately trying to shorten things and give everybody the snappy soundbite information that they believe everybody wants. And I think to an extent that's true in the entertainment world. But I think it's also been extended to finance because the finance channels are run by networks who are in the general business of providing entertainment. And there's a one-size-fits-all approach to it. That if our entertainment channels, everyone's turning off after 15 minutes, then we need to make our finance channels the same length. And I just think that's a catastrophic mistake, both for the networks and more importantly for the people that listen to that content and make investment decisions based upon.
And I'm glad you also mentioned that word rigorousness, right? That this idea that you have to kind of stress test the thought process that goes into the conclusion, which is the opinion. I've always made it a point on the road when I presented CFA chapters that as somebody who used to do the CNBC rounds and the Bloomberg rounds and listens to news and different pundits, the reality is most people on what I would argue are traditional media through these sound bites are saying things which you can't actually validate, that have no real back-tested, predictable usefulness. So the only way you can really get a sense of if somebody is thoughtful is with some degree of time and some degree of Socratic method to see if you can really unravel what's really behind their thinking. And I think that's, Real Vision, I think, does a good job with that. I think you do a phenomenal job with that on your podcast as well.
I think there's another aspect to this that's important, and that is you can stress test a thesis and come up with something watertight and still be wrong. And the perfect example of this goes back to, I guess, 2013, 14, somewhere in the 14 probably. And this is my friend Carl Bass's rational investor paradox, when he talked about the Japanese markets, talked about the yen, talked about the JGB market. And he wrote a beautiful investment case as to why the yen would weaken, as to why the Japanese government bond market was in trouble, as to why the Bank of Japan were in a terrible place. And you go through that, if you go through that investment case that he made, and I think if you Google rational investor paradox, Carl Bass, you'll find it. It's as good an investment thesis as you could ever hope to read. And if anyone that reading that, including me, would have read that and said, "Yeah, this is really hard to find a fault with," except, right, as it turns out, 8 years later, okay, it finally looks like a lot of the things that Kyle said were problems are starting to bubble up and are going to have to be fought by the Bank of Japan. But what Kyle couldn't possibly have known was how long the market would tolerate this seemingly incoherent set of circumstances which ought to lead to a certain outcome. And the markets have tolerated them, and they have taken the Bank of Japan at their word when the Bank of Japan have said that we won't let rates rise above a certain level, and we're going to push our interest rates to the floor for a lot longer. And suddenly, we've seen in the last couple of months the Royal Bank of Australia trying to do the same thing as Japan. They're obviously a much smaller country, a much less important central bank. I don't mean that in a denigratory way to the Aussies. That's just the facts. They did their own yield curve control. They were finally forced out of it back in October of 2021, and rates went from 0.1%. They moved up 100 basis points in the space of days, if not weeks. And so here we are. Japan is in the crosshairs of the same situation, but they've been in that situation for the last 10 years, and it hasn't mattered. But suddenly, we're seeing stress on the yen. We're seeing stress in the JGB market. We're seeing the BOJ get more frantic. And what is it that's made that change? One would argue that it's inflation. And inflation, I'm sure we'll talk a lot about inflation because I think it's arguably the most important thing for everybody to think through. But just the emergence of inflation has created a situation where the Bank of Japan can't have their cake and eat it anymore. And so now that investor paradox that Kyle put us all on notice of, the clock is ticking. And at some point in the not too distant future, absent something completely unexpected happening, the Bank of Japan is going to be tested by the bond market. And that's going to be a big deal if and when it happens.
No, and to your point, it's like that old saying, nothing matters until it matters. And then when it matters, it's the only thing that matters, right? Which is really what I think is the argument for Japan. And I'm glad you were going in this direction, because I think this is wildly important to consider, which is that in this domain of investing, of markets, you can be wrong and make money. You can be right and lose money. And there's a fine line between being early and being wrong. So those who were, banging the table about the housing crisis, when it peaked in '06 to then causing, great market crash, to great financial crisis, they were wrong up until '08, right? And then suddenly they were right 2 years later. So the time frame with which anybody evaluates any thesis is really critical in determining if it ultimately is right. And it can take time, right? We live in the small sample. Years can still be a small sample to evaluate any outcome within.
Well, I think that's a great point. And I think the mistake that a lot of inexperienced investors make is they read these things, they read these cases for a certain outcome to happen. And look, generally speaking, they're written by very smart people and they are compelling. It's not often you read these things and they're not compelling cases. And the mistake that inexperienced investors make is they rush to do something about that. What you find a lot of the experienced guys do is they'll file that away. They'll understand, this is a definite possibility, but they'll wait until they see it playing out before they'll jump in. And a great example of this on a more micro fundamental basis over the last several years has been Tesla. This has been, and I get accused of being obsessed with this stock. I think fascinated is the word I'd use, but if people want to use obsession, then that's not my call. But for me, that stock has represented so much in terms of understanding the markets, understanding the environment we're in, understanding the retail mindset, understanding what's important to investors right now. And there was this group of distinctly unorganized investors called Tesla Q who all believed that the company was ultimately going to go bankrupt, and there was all kinds of fraud going on, and the numbers were cooked, et cetera, et cetera. There's a whole rabbit hole there for people to go down if they haven't already. But I think what was important there is, on the one side, you had the narrative of all these people saying Tesla's a short, Tesla is going to zero. And on the other hand, you had the zealots that believed it was going to the moon. And if you judge the situation on the stock price, the zealots have won and the shorts have been utterly and completely wrong.
For now.
However,
for now.
Right. For now. But the point I wanted to make was that during that time, most of the Tesla Q shorts who were experienced investors, they haven't had the position on. They recognize a market that's going against them. They recognize when it's a battle you can't win. And yes, fine, they may buy some puts around numbers releases. They may see that the stock's starting to crack, and so you put some on. But they're professional investors. They have stops in place. And so this idea that the short sellers, and I think when people use that term short sellers, they're talking about professionals who supposedly are evil and short the market at their will. Those guys, they may have taken a few licks, but they're not out of business. They haven't been carried out. And I promise you, none of them, apart from nibbling around when earnings were about to be released, has had a short position in Tesla for several years now. But they will be sitting there now. They're watching what's happening. They're watching how the narrative has turned against Elon Musk. They're watching how the press he's getting is a lot less kind to him than it was a few years ago. They're looking at the multiple investigations. They're looking at plant closures. And they're kind of dusting off their thesis. They're dusting off their playbook. And they're starting to try and get a sense of what the catalyst would be to make them come in and go short again. And that's, I think, in a nutshell, the importance of understanding these theses, and not, if you're inexperienced in the markets, rushing in to put a trade on in day one. Because nothing goes to zero in a day. Nothing goes to infinity in a day. These things take time. And it's not really until you see the thesis playing out that you need to get involved. You're not going to miss out on untold riches if you don't get the short or the long on immediately the day you read a certain investment case, And I think that's something that inexperienced investors really need to try and understand is the kinds of catalysts that professionals look for to tell them, okay, this thesis is now in play, and I'm going to watch it much closer now than I have been, and I'm going to look for concrete signs that there's a tailwind to the trade that I can actually ride.
But to your point, that's very difficult because that relates directly to the earlier point about attention spans, right? Because people, I think part of having a short attention span is thinking that in the idea that something plays out tomorrow, that it's an event as opposed to a process, right? Process takes time. which takes a longer attention span. Events are shorter term in nature, right? And I think, unfortunately, and to your point, and I see this a lot on Twitter and a lot of the conversations I have with investors as well, everyone is so short term that they're constantly looking for the catalyst and immediately thinking that this time it's different or this approach needs to change based on what's happening in the current environment. And you can't invest based on that type of a mindset.
Well, look, you can, but it's dangerous, and people shouldn't do it, but they do. And I think this idea that everything is a trade is very of the moment. It's very it fits with that short attention span. There's a definite difference between trading and investing, and everything's become a trade. And because of that shortened content, because of that snappy clickbaity stuff, people who are providing that content tend to move on to the next shiny, sparkly thing that's going to get them the clicks. And so what you end up with is someone talks about an idea, wherever it be, either on financial media or in a blog or whatever, wherever, on Twitter, and people will invest based on the logic of the case they've heard. And then they'll wait. They kind of orphan that position. That people don't take ownership of that position. They wait for the person that told them to get in to tell them to get out. And that person may not tell them to get out. They may just get out themselves without telling the whole world. That's just the nature of the beast. So, another problem that I think we face today is that people will take on positions that they think sound like a good idea. And then instead of saying, okay, I now own this position, it's my responsibility, no one else's, I have to monitor it, I have to get myself out or hedge it or do whatever, reduce it, whatever I may have to do. And no one's there. There's no safety net for me. This is on me now. And I think the Terra Luna collapse recently was the perfect example of this. Here's a bunch of people in something that they had assumed was going to be great. They assumed that, hey, I'm going to get 20% forever for this thing, and there's no risk. This is amazing. And we all know what happened. But it happened in 36 hours. So there was no possibility to risk manage. So, it's a very, very dangerous environment to be speculating in right now, Michael. There's no two ways about it. Arguably the most dangerous environment that I've seen in almost 40 years in the business.
And I've put that tweet many times over the last several months that this is far more treacherous than the 2020 COVID crash, and I would argue far more treacherous than 2008, because at least COVID, you had treasuries as the counter asset. At least during 2008, yes, you had Lehman, but then you had this massive run in long duration treasuries as yields collapsed into the end of the year, and you could have made up all your losses and then some if you were fully exposed to Lehman. It's not clear if you have any of those kind of convex type of movements to counter a large drawdown in equities, because in this environment, you've had, in some cases, larger drawdowns in bonds, which makes it really hard, right, from a speculation standpoint.
Well, I mean, if you think about the COVID pandemic, you could sit there with reasonable assurance and say that the government/central banks will step in because this is an economic disaster. So you kind of knew there was a backstop there. You didn't know where it was, but you knew, given the speed and the severity of the fall, that it wouldn't be long in coming. So there was certainly a catalyst there for a reversal once the market started falling in March. Now, what you have is inflation. And so the problem is now rising prices, rising cost of living. That's the problem. And bailing out the stock market is not a solution to that problem. The solution to that problem is to somehow get the cost of money higher and dampen inflation expectations. And so the stock market, risk assets, might well be collateral damage in that. So again, people assuming this buy the dip is there forever. Not so much, I don't think. This time around, a 20% fall in the stock market isn't the problem it's been in previous times, because it's happening in the face of inflation. And I keep coming back to inflation wherever I start. I end up with inflation and understanding what a difference inflation makes. And we've had 40 years of an essential deflationary tailwind. And for those 40 years, there have been several things that have worked incredibly well. Buy stocks, buy bonds. They're going to work very well, and the government will come in if we get a problem in asset markets, because we didn't have any other problems, really. The financial crisis came along. They had to solve that because it was systemic. And other times they have pivoted to save markets when they've been trying to raise rates. So they've been trying to raise rates not because they had to face inflation, but because you can't keep the cost of money at zero forever. So they induced those corrections with their attempts to raise rates, and they came and tried to bail the market out from their own folly. This time it's very, very different. People have to understand this. People have to understand that this inflationary pulse is incredibly important. And is it over? Will it moderate? Possibly, but expectations right now believe that it won't. If you listen to people in the street, you listen to conversations in bars and restaurants, you listen to people talking at the petrol pump forecourt or the golf course, all everybody's talking about is how much it costs to fill their car up with gas, or how they couldn't get what they wanted at the supermarket. We're in a very different time now, and that's become entrenched in investors' mindsets, or not even investors' mindsets, but just the man in the street's mindset is entrenched that inflation is a problem. And so saving risk assets, if they go down 20, 30%, doesn't solve that problem. And people need to understand that.
Well, which is interesting, right? Because inflation is now people's small talk, right? Which is really remarkable, actually, when you think it's the equivalent of the water cooler conversation. Now, earlier in the conversation, we talked a little bit about mistakes that investors make. One of the most common mistakes investors make is to think that this time is different. And this dovetails directly into this disinflation paradigm shift, whether it's really transitory, because the reality is nobody ever really defined how long transitory is, right? Or if it's a structural change. Lay out the thesis for, because it sounds like you believe this is sort of a multi-year cycle that we're in of higher inflation. Lay out the thesis that this is a structural change as opposed to an anomaly. And the reason I want to go in that direction is I don't believe the disinflationary forces ever went away. You still have demographics, which are problematic longer term. You still have technology, which puts downward pressure on prices. And you still have a very wide wealth gap, which in and of itself is disinflationary. So assuming that supply chain disruptions eventually moderates, assuming that the total wealth lost in equities and bonds is more impactful towards draining liquidity than the Federal Reserve hiking rates, lay out the argument that this really is sort of a longer lasting type of environment that we're in.
Well, look, going back to what we said earlier, who knows, right? We don't know. But what I can say is this, that we have seen there's a big energy component to this. And whether it be on a policy level, particularly here in the United States, or a geopolitical level, the structural imbalance in the energy markets is not going to magically get cured. We're not going to see the Saudis come out and say, right, we're going to pump another 1 million barrels a day and everything will be fine, because it won't. Added to that, you've got this move away from globalization. You've got countries that are realizing that physical assets that were once up for sale on the open market are no longer that way, because we're talking about basic commodities, we're talking about food, we're talking about energy, and these are things that countries need. It's not a question of they want them, they need them in order to function. So you're going to see countries with resources get very protective about them. You are going to see countries like America try and onshore their manufacturing industry again. We've already seen evidence of that, because to be dependent upon China for the parts that go into crucial finished products, or on Russia for energy, as we've seen in the last 6 months, is a massive potential problem. And so whatever the cost, countries are going to have to find a way to be a lot more self-reliant, to harvest their own natural resources and make sure that they're okay before they start sending those products out to the rest of the world. That changes the political situation, because suddenly domestic politics trumps international politics, and countries will be acting in their own interest. So we have a very, very different backdrop. Now, the demographic situation is still absolutely there. I agree with that. The what's my train of thought now?
The wealth gap or the technology aspect.
Yeah, the wealth gap is still, none of that's gone away. However, in order to solve the problem that we face immediately, we have to take steps to curb inflation. Now, the demographics question is a very good one to pick, because we have a case in point in Japan, where when I moved to Japan in 1989, I remember reading very soon after I got to the country a study that said that the population of Japan would start declining in 2015 unless steps were taken to increase immigration and kind of mitigate the falling birth rates. And that was 1989. So we had a quarter of a century until 2015. And sure enough, right on time, the Japanese population started declining, because nothing was done about these trends. So the deflationary forces that we see are long-term trends, long-term problems. When you talk about the birth and death rate of a country, and you talk about how, in 50 years, if we don't do something, the population's going to do X, people's response is, well, in 5 minutes, if I don't get some more money, I can't afford to put gas in my car. Come back to me about the demographic stuff, because that's not a problem to me right now. So the deflationary impulses are much more structural, much more long-term in nature. And the inflationary impulses are right here, right now, and everybody is reminded of them every half mile when they're driving their car, because they're looking at the price of gas and remembering the gas station where it's cheaper. So that next time they fill their car up, they're going to go back there and save a penny a gallon. So the inflation is a short-term problem, but it's an expectations-based problem. If people believe that inflation is here for a while, they will adjust their behavior accordingly, and that will not lead to lower prices. So you've got to crack that in order to get rid of the inflation. And if you do manage to kill this inflationary impulse, and it will die of its own making at some point, but if you do manage to kill that, you are then going to be facing a very different world where you think, well, okay, we've got through that scare, but unless we onshore our manufacturing, unless we develop our energy markets, we could be in the same situation again, and the world is just not as friendly as it was 5 years ago. So this is a huge tug of war between inflation and deflation. When people ask me, is it going to be inflation or deflation? I say, yes, it's going to be both. It's the sequencing that is important to try and get right. Right now, it's inflation. We could see a deflationary impulse, but it could easily get overwhelmed by inflation. So again, we come back to what we were saying earlier on. If you're an investor, you don't pick a side, put all your chips on the table, and then sit and wait. You look right now and you say, okay, we've had a terrific run in commodities. There could very, very easily be a pullback in commodities now, but is the inflationary impulse that's driven them higher? Are the shortages, are the kind of privatization of national resources over? And the answer is no. Are prices under control? No. Are interest rates anywhere near neutral? Not a chance. So there are plenty of reasons to believe that if we do get a deflationary impulse, which we might, that it could be a buying opportunity if you believe in inflation. Now, certainly at the moment, and for the last 7 or 8, 9 months or so, I've been firmly in the inflation camp, and I'm still there. Although I'm much more cautious now in the short term that we could see what looks like deflation come back, but really it's more likely a correction in a whole bunch of things that have gone too far than the death of this nascent inflation.
I was smiling when you made that point about, is it inflation or deflation? And the answer is yes, because I've said that for years, because I'm with you 100%. It's always about the sequence of returns. And I've put out that tweet a few times before that: inflation short-term, deflation long-term, because debt at the end of the day is still disinflationary, deflationary, because it increases default risk. And the more rates do this, right?
If you look at the chart of interest rates, right, you can see that they go down basically for 6,000 years. If you look at that great book by Silla, but we had that 10-year period in the 70s where we had rampant inflation. Interest rates had to compensate for it. And if you look at the long-term chart, it's a blip. It really, you barely notice it. But if you lived through those 10 years, it was anything but. If you lived through Weimar inflation in Germany in the 20s, it was anything but. If you lived through the hyperinflation in Yugoslavia during the Civil War in the early 90s, it was anything but. These are short-term phenomenon, but they completely and utterly destroy society. And so if you want to be right in the long term about deflation, yes, but what you're going to have to sit through potentially in the interim in order to be right in the long term is so painful for most people that it's impossible to do. It's very difficult to sit there and say, oh I realize that real rates are negative 6% and my money's getting eaten away at 10% a year, but over 30 years I'm going to be fine. Because you're not. You'll have lost a significant chunk of your capital. So it's really important to at least, I was going to say get the sequencing right, but there's no guarantee you can get the sequencing right, but be awake to the possibilities that even if you're a deflationist, right now you have to be positioned for inflation. Just hold your nose and do it, and pay close attention to the signs that you believe are the most important ones to tell you, okay, the winds are shifting again and there's going to be a tailwind behind my deflationary thesis. I can get myself positioned in a way I'm more comfortable. But to sit there and say, I believe it's inflation in the short term, deflation in the long term, and so just take the deflationary position, there aren't many people who have the kind of intestinal fortitude to be wrong on a bet that big for a significant period of time and just hold their metal and ignore it and see what happens and wait for 10 years time when the smoke's cleared. It's a very, very, very difficult thing to do. And if you haven't structured your book correctly to give yourself the best chance of being able to withstand that inflation in the interim, you've got no chance of coming out of that alive.
100%, especially if you're managing funds around that particular thesis,
right,
because
right.
you won't even be around. Your investors won't stick with you long enough in that. I want to go back a little bit to this onshoring discussion, because I've made this point a few times before that I believe there's another big debt binge coming, because if you're going to onshore manufacturing, natural resources, exploration, all this, that requires more debt to do that, to get that redundancy in your countries, right? But that seems to be very hard to onshore if the cost of capital keeps on rising, right? So it seems to me that there's this dynamic that maybe slows that narrative down, even though we all agree that we're in this environment where you need to onshore more. The cost of capital may not make it so feasible.
Yeah, look. I think it's really important for people to understand one key point is that right now, every option is on the table. There is a possibility that literally anything could happen. And it sounds trite and it sounds like, well, you can always say that. But no, for the last 40, 50 years, there has been essentially zero chance of some kind of global conflict. That is not the case anymore. And so you have to understand that right now, anything is possible. And so, again, that favors the professional investor that knows how to size positions correctly, how to hedge their risk effectively, and how to, frankly, be wrong, cut a position, take the loss, and not worry about it. It's very, very, these sound so easy, these things, and they are once you've screwed up enough times that they're burned into your soul. We've had this kind of one-way ticket in markets for the longest time, and this buy the dip mentality has worked. And so what's happened is people have become conditioned to the fact that, hey, when you buy the dip, don't worry, it might be painful for a little while, but it'll come back. And it has. And that the more that gets reinforced, the more people tend to believe it. And the more pain it causes ultimately when those conditions change, because it takes a while for people to realize that. And because of the longevity of the kind of markets we've seen for, as I say, the entirety of this decades-long deflationary tailwind, there are very few people around who have traded markets like we have right now. And if you have a mentor or someone that you work with that's been around, they can tell you all the things you should do. But realistically speaking, all the things you should do go against everything you've been conditioned to understand works. And it's a very rare person that can effectively forget everything that their experience in markets has taught them, take the word of a quote unquote boomer, and change their strategy and tactics accordingly. It's a very strange, a very rare individual that can do that. So for the most part, people are now trying to adapt and learn a new trading environment, a new investing environment, and you don't learn how to do that without losses. There's no free way to learn how to understand a market. It is going to be painful, and the trick is making your mistakes cost you as little as you possibly can.
Right, without the risk of ruin, right? Which is what really comes from leveraging. And that's another interesting direction to go at, because the argument that stocks are for the long run assumes that leverage does not permanently go higher. Because I would argue that's really been what the Japan trap has been. It's, as we know, it's about debt to GDP and leverage in the system. And a lot of very smart people have made the argument that we're headed towards that direction of Japan. I would always argue that that's a sample size of one. So who the hell knows if the U.S. ends up playing out in the same way, let alone Europe. But talk about some of the structural dynamics in terms of risks to the system when you have this constant re-leveraging that's happening. Maybe this is sort of the inevitable can kicking back, right, with inflation, because you can't re-leverage if you have a big decline in risk markets because you still have higher prices coming. But that seems to me the real root cause of every problem that we have.
Yeah, look, leverage is invariably either the cause or the accelerant to any of these problems we have from time to time. Anytime you have leverage in the system, it just means there is an increasingly small buffer to withstand any downdrafts. And we got the perfect look at this in 08, when the banks were leveraged to the point where 3 or 4% fall in certain assets would wipe them out. Now, for you to get to that point, to be leveraged to that extent is unconscionable, frankly, but it was encouraged by the sense that, hey, we're backstopped here. If anything happens, we're systemically important. We'll be too big to bail. And we're getting a good view right now of what happens in those situations where people aren't too big to fail. If you look at the crypto space right now, we are seeing leverage being unwound in the crypto space. We're seeing billions of dollars getting evaporated, and there's no one to step in. There's no protection from the regulators. There's no protection from the central banks. I mean, even though some people in the crypto space have been kind of begging for intervention, it's not coming because you're not systemically important yet. And that's the perfect example of how leverage can kill you. If you're over leveraged, and I think we're going to see this, Michael, to be honest, in the housing market. We've seen an enormous amount of leverage build up, not necessarily in the United States this time, but if you take a look at Canada, you take a look at Australia, New Zealand housing markets, and I wrote about this last month, you'll see an extraordinary amount of leverage in those systems to the point where those housing markets, in comparison to where the United States got to in at the very top just before the 08 crash, these three countries are of a magnitude multiples of that. And so when you look at what happens when there's that much leverage in the system and rates start to go up, it's incredible how fast this stuff happens. It's incredible how suddenly auction sales of houses in Australia can hit a brick wall. It's amazing how people stop borrowing. It's amazing how many houses, a big percentage of which are on the market now, have price cuts in them because people are desperately trying to offload these assets. And down in Australia, housing is recourse. It's not non-recourse loans like it is in the US. You can't just mail your keys to the bank. So there are major systemic problems attributable to leverage, which, again, inflation, which triggers rising interest rates, which will expose the leverage. So everywhere you look, the whole world has become reliant upon effectively zero cost of capital, and that's been taken away. And if you think about the importance of that zero interest rate policy, i.e., money has essentially been free, well, if something's free, people are going to make as much use of it as they possibly can. So there is maximum leverage in the system at the worst possible time. Of course there is. So you start turning the screws and ratcheting rates higher. They've done it before incrementally in several timeframes over the last 20 years as they've desperately tried to get off the zero bound, and the markets have basically repudiated that and told them, no, we're going to throw a hissy fit. They've had to come down. Now they don't have a choice because of inflation again, right? And inflation very quickly becomes a political problem. It's not just a market-based thing. It's not just, oh, banks are in trouble. This is a case of, well, unless you get inflation under control, you're going to get destroyed in the midterms if you're the Democrats, which I fully expect will happen. And unless you get it down by 2024, you're out. I mean, presidents of any side don't survive double-digit inflation. The economy is the most important thing, no matter what anybody says. So now you have the situation where the politics are involved and the administration are going to be squealing at the central bank, the independent central bank, to do something about this and get inflation under control, not get markets down, get inflation under control. And if there's collateral damage, we'll deal with that. And I'm sure they think, well, there'll be people, we can bail some people out and we won't bail others out. And I'm sure it'll be fine. But first and foremost, get inflation under control. And Powell and the Fed have been doing everything they can and taking every opportunity to try and convince people that they're serious about this. And it's a really interesting situation they find themselves in, because previously when they've said that we're going to raise rates, the market said, yeah, you won't raise rates, you can't raise rates. And they've kind of been happy to go along with that because they've wanted the animal spirits, they've wanted asset prices to go higher. They've spent an awful lot of time trying to jawbone markets up and expectations in the right direction. Now they're trying to jawbone the markets into believing that interest rates are going to go up. But again, they've conditioned the markets to not believe them. So if you want to convince the markets, you're going to have to raise rates and you're going to have to be aggressive in doing it. So another 75 basis points next month is, I would say, a probability rather than a possibility. I would say 100 basis points is a possibility, simply because that's the best tool they have right now to convince people they're serious. If they can convince people they're serious and lower expectations, then maybe they can back off. Now, they might break something in the meantime. They probably will. But until they can convince people they're serious about this, inflation is going to continue to be a problem. So we have to watch out now that a political situation is going to be played out through financial markets. And I think if the last 10, 15, 20 years have taught us anything about politics, is that the reach of politics and the aims of politics have only become more concrete in this idea that the only thing we care about is getting in power. And once we're in power, the only thing we care about is maintaining power. And so how do you maintain power in a time when there's double-digit inflation? You kill it. It's the only shot you have at maintaining power. So the political nexus of the Fed and the government is going to become a lot more important. And everybody that believes the central bank is independent, I think you're whistling past the graveyard. I think they want to be independent. They've tried to be independent. But again, we haven't had a situation like this where inflation is the problem. And so the politicians haven't needed to try and force the central bank's hand. Now they do. In Australia, in fact, recently they stepped away from yield curve control, as I said, and the Aussie 3-year went from 0.1%, 10 basis points, up to 1% in a very short space of time. The central bank governor, on the equivalent of a 60 Minutes TV interview, basically apologized and said they'd kind of got their forecasting wrong. And the next thing that happens is the government commissions an independent review of the central bank. Well, I wonder where that's going. So get used to seeing the nexus of politics and central banking become a lot more obvious in the months to come.
Yeah, and it makes sense. I shared at the top of the space a tweet I put out that inflation's not a monetary phenomenon; it's a leadership phenomenon, right? Because whether it's the Fed or Congress or the president, it's always about. It's very easy to stop inflation. It's with one word: austerity, right? That, at the end of to your point, that's how you kind of really crush it. But you can't really do that unless you have leaders making tough choices. And you're right. The only way to stay in power is to kill off inflation here, because the longer it persists at this level of acceleration, the more likely it is that those politicians get voted out. But there's this counter aspect to that, which is that you can't get really voted in unless you promise more. You never get voted in for austerity. So you do end up having, you can argue, sort of this longer term pressure on more debt, which creates more dislocations, more leverage, more inflation cycles, more deflation cycles, just more amplified over time.
Yeah, that's very true. But if you think about the voting public, all they care about is stopping the pain that's happening now. They're not going to vote based on a very careful, well-considered assessment of both sides' policies and which one they think might be in their better interest long term. They are going to be pissed at the Biden administration for the cost of living increases, and they're going to want change. And they'll hold their nose and they'll vote for something different, because that's what people always do. If the circumstances are bad, we vote for different. This is how Trump got elected. This is how Brexit happened. And believe me, it will be the same. Assuming we still have inflation like this in 2024, then people are going to vote against the situation in which they find themselves because they don't want that to continue. And I don't think the Republicans will need to promise certain things to get in. All they'll need to do is say, like Carter did with whip inflation now. Remember those badges back from 1970? We're gonna kill inflation. Well, how? Don't you worry about that. You elect us, and we're going to get rid of inflation. Okay, all right, fine. Well, it can't be worse than it is now because I can't afford to feed my family or drive to work. So, this is always how this change happens. Unfortunately, voters don't make these elections matters of policy. They're popularity contests. And if you can't afford to feed your family and you can't afford to drive to work, guess what? The guy behind the lectern in that big fancy house at 1600 Pennsylvania Avenue, you don't like him anymore, and you want another guy to come in and he'll do something, I'm sure. It's just the way of it. And the more politics has become a reality show and a popularity contest over the years, the more amplified that rationale among voters has become. It's a shame, but that's the reality of it.
I want to go back to your point about housing for a moment. This idea that with leverage so high in the housing market, you mentioned Canada, and I put out some research on that as well. It's remarkable how insane prices have gotten there and home affordability. But to that point about as rates have spiked here, there's this almost aggressive about face in demand and all of the aspects that go into housing creation. It seems to me that that would actually argue that you could have a shock disinflation pulse, right? Because housing historically is a pretty big component of everything that we see
Yeah.
with inflation. So if we go with this narrative and this idea, which I think is valid, that this mortgage rate spike in the U.S. and it has different effects in other countries, obviously, that creates a very abrupt about face in housing demand, then that probably means, I think, that you'd have an about face in inflation. But what are your thoughts on that sort of idea of the speed with which this could maybe break?
Well, it's fascinating to watch. The housing market is so sensitive to rates, and really all we've seen for years now is how sensitive it is on the upside. Right, we keep saying, "Oh my God, housing prices have gone to new record levels," and we all saw what happened in the pandemic, and we saw how crazy house prices became. But if you just look at it as a simple mathematical equation in terms of the average amount that people can borrow and service, it's a problem. When I bought my first house back in the late 1980s, the mortgage rate was, I think, 12%, which seems ridiculous today. But I only had to borrow $50,000, so the payments were the same, and so that's how this whole affordability thing works. If you look at the average mortgage payment if you keep the average monthly payment steady with these rising interest rates, it cuts the price of the house that you can afford by 35-40%. So on a simple mathematical basis, in order for the equilibrium to be maintained, based on where people can borrow right now, house prices have to come down 35-40% to make them affordable, or to make them the same level of affordability, which is already more unaffordable than they've been in 40 years. So there are obviously different components to that. There are plenty of people that will pay cash and don't need a mortgage. There are plenty of institutional buyers who are buying thousands and thousands of homes. That unfortunately gets reflected in rent, which goes into the CPI. So that's not necessarily the best thing of all. These guys are able to buy up houses at really cheap levels and keep the rents the same on them. So it doesn't really help society as a whole. But yes, of course, if the housing market collapses, it will be a disinflationary pulse. There's no two ways about it. But if you think about what that means, it means all the things we saw in 08. It means bankruptcies. It means banks having problems. It means the Fed being forced to come in and do what they've been trying to do this whole time, which is kill deflation and turn it into inflation. So again, this is one of the perfect situations where we don't know how this will play out, but we can look at the various inputs and we can see where the stresses are. The stresses are now definitely weighted towards house prices stalling, which is happening already, and then falling, which has begun to happen in certain markets. How dramatic that slide gets, we don't know yet. We just don't know. But if rates continue to go up the way they have been, we've seen mortgage rates, 30-year mortgage rates go from 2.5% to 6% in a couple of months. It's the fastest increase that we've seen in recorded history, as far as I've been able to find. Maybe you can correct me on that. But it's certainly a dramatic and very swift appreciation, and that catches people by surprise. And of course, anyone that was looking at buying a house is thinking, well, maybe I'll hold off. Anyone who was stretched to afford one is now thinking, well, I can't afford this. So all the ingredients are there for the housing market to come under significant pressure again. Now, the US is in a lot better situation than most countries because they have a significant amount of their mortgages are fixed. They've got the ability to fix rates for 30%, for 30 years, which you don't have in the UK, you don't have in Australia or Canada. 5 years is about the maximum you'll get. So you've taken some of the volatility out of the equation. The banks are in better shape. So the US this time around is probably one of the better positioned countries in terms of real estate. But the order which the deflationary pressures from a weakening housing market, and if the Fed are forced to cut rates to stabilize the housing market, well, again, then you're back to fighting inflation again. So everything that's happened over the last sort of 20 odd years in terms of Fed policy, lowering rates, raising rates again, or trying to, and failing and lowering them again, has been done without that kind of boogeyman of inflation standing over you. Because now, every time you pop your head out and say, right, we're going to cut rates again, inflation is there waiting for you saying, yeah, you cut rates again, see what happens. That's not been an issue for a long time. So again, people have to learn that and understand what changes that makes to all these equations. And we don't know yet, right? Because the Fed have been hiking to try and get back to somewhere close to neutral, or at least to convince markets that they're earnest about what they're saying they're going to do. We haven't seen yet what happens to inflationary pressures if they do cut rates, if we do get a recession, if they do decide to pivot. It'll be great for asset prices in the short term, I'm sure. But what happens to inflation? Before, we haven't had to worry about it. It went from 0.3% to 0.4%, and everyone was like, yeah, there's no inflation, we don't have to worry about it. This time around, if they say, right, okay, we're panicking, we're going to cut, we're going to pivot, we're going to cut rates now, what happens then if inflation jumps again? It's a completely new world for everybody, for the Fed, for the government, for investors, everybody. And we won't know until we see that first pivot, and we won't know what we're dealing with until we see how inflation reacts.
By the way, on the point of housing, that's why my eyes have lumber and gold, because
Right.
lumber is the key component. And this relates to one of these papers I put out that shows that historically lumber weakness tends to precede major tail events in equities because of the link to housing, because the average home has about 16,000 board feet of lumber. And gold tends to be a risk-off safe haven asset, not as consistent as treasuries, but still serves that role. So it turns out if you compare the two to each other, it tells you a lot about conditions favoring a potential black swan, right? Not knowing exactly where the black swan shows up, but the environment under which it's likely to appear. So for the last couple of minutes here, Grant, I luck is oftentimes the variable that throws a thesis off, that throws a model off, right? It's the error in an equation. What's the good luck situation? How could this end up going right? Because I do a lot of these spaces, and I think everyone is on the negative narrative train in the same way. And you're correct. It's really ultimately about the sequence of returns. It's about the path, not the prediction. But is there any scenario where you can make a case that we might actually get lucky globally and come out of this where inflation isn't persistent for as long as people are talking about, and that we kind of revert back to the markets of old?
Yeah, I mean, of course there is. There's always a chance. And people who invest based on the fact that there's no chance this could go wrong tend to end up losing money. But it's interesting you asked that question, Michael, and used the word, can we get lucky globally? Because I think that's the change now. Everything used to be global, and now I don't think it is. So can individual countries, individual regions get lucky? Potentially, yes. Can the whole world find a nice, safe, peaceful path through this where everybody's inflation starts to come off and everything? No, I don't think there's a chance in hell of that happening. If you look at what's happening in places like Sri Lanka and Peru right now with their inflation, which has obviously gotten way more out of hand than it has in the West, and things like food inflation and energy inflation in places like Peru are a much bigger problem. And so Peru is one side of the coin. Let's pick on Australia again. Australia is the other side of the coin. Their inflation isn't hitting 8% yet, like it is in the US. So they have a different set of problems. They're in a lucky position of, okay, how do we get ahead of this now? Because we haven't had the same problems that other people have. How do we make sure that we don't get them? Well, of course, the answer for Australia is you raise rates. But with the Australian housing market the way it is, that is potentially catastrophic for Australia. Come back to the US, you've got 8% CPI, and you're most likely going to see that moderate now. You're going to start to see some base effects come out. You're going to start to see the prices come down. So what could go right? People could believe that inflation is moderating. And they hear the data, and the CPI drops to 6, and people go, oh, okay, great, 6. We're on our way to 4. We're on our way to 2. The Fed have got it right. Great. That could alter behavior, but they've still got to fill their car up. They've still got to go grocery shopping. And there's a very strong chance that things like that don't come down in price because of the continuous supply chain issues. If you go to somewhere like Japan, we started talking about Japan. Here's a country that has this insane policy by the Bank of Japan that they are bidding an unlimited amount for the JGB at 25 basis points, and they haven't been tested yet. Well, but guess what? Not only are inflation pressures gently starting to rise in Japan, they're back above the 2% forecast of the Bank of Japan, but only at 2.5%. And remember, this is a country that's had 20, 30 years of deflation, but they are up there. And recent surveys suggest that already the Japanese are getting a little upset about inflation because, when you've had 20 years of prices staying the same or going down, if they start to go up a couple of percent, it's meaningful to you. And so the Bank of Japan governor, Haruhiko Kuroda, had to apologize for comments he made that Japanese citizens were more willing to accept price hikes. That created outrage. So again, the inflation narrative is changing in Japan. So it's tough to see a smooth landing in Japan. And then you go to Europe and you look at input inflation, producer price indices that are anywhere between 25 and 40% across developed, German PPI is 36%. It's unfeasible. And so those costs have to be passed on somewhere else. So look, everywhere you look, in each individual jurisdiction, there are plenty of reasons why there is no obvious soft landing excuse to all this, but you hit the nail on the head. You said luck. Could there be something lucky that happens? Yeah, there could. We could see Putin surrender and pull out of Ukraine and at the same time open up the natural gas taps to the world. We could see the Chinese back down and decide they don't want to be as big a power as we've seen. We could see them reopen their economy, and we could see manufacturing supply chains smooth out. We could see countries decide that, hey, we don't need to re-onshore our manufacturing process because that was just a blip and everything's going to go back to normal. All of these things are possible. I just think when you handicap them, they're all a different shade of unlikely.
Yeah, no, and I agree with that. And I only mention that because when everyone seems to think that it's going one direction time and time again, going back to the unknowable future, something happens and it ends up being the opposite of the crowd. And you only, going back to being an experienced investor, you only recognize that through the earlier point about going through losses and being proven wrong in a thesis because of something that comes up that nobody ever saw coming. Again, either good or bad.
Exactly right. Exactly right. And you just have to be aware that anything could happen to change your thesis at any time, and have the humility that if something happens that looks like it's changing your thesis, do something about it. Don't hope that you're wrong and it's all going to be okay. If you think it represents a clear and present danger to your positioning, you owe it to yourself to do something about it. Don't just kind of think, maybe it'll be okay, because that's irresponsible, and that's how a lot of these losses happen. It's okay. It's okay to be wrong. It's okay to be positioned for inflation and suddenly go, oh my God, deflation is what I have to worry about. That's fine, because don't beat yourself up. You were trying to guess the future and you got it wrong. So accept that, reposition, or get back to square and think it through, and maybe you end up putting the same position on again, but you can do it with more confidence. This fear that people have, or unwillingness rather, to take losses and be wrong, is one of the biggest handicaps in trying to navigate normal markets, let alone the markets we're facing right now.
Yeah, very well said. Everybody that's here, please make sure you follow Grant Williams here on Twitter. Check out his phenomenal podcast series as well, Things That Make You Go, Grant, the first time you and I are speaking, a real pleasure to talk with you. I like having people that are experienced and have that humility in the way that they frame the unknowable tomorrow. So really do appreciate the time here. Again, everybody enjoy the rest of your Sunday. Thank you, Grant. I really do appreciate it.
Great pleasure, Mark. Thanks for having me.